There is an investing strategy that has beaten the majority of professional fund managers over virtually every long time period ever studied. It requires almost no effort to execute. It costs almost nothing to run. It doesn't require you to research individual companies, predict market movements, or watch financial news. And it's available to anyone with a brokerage account and as little as a few dollars to start. It's called index fund investing. And if you've never heard of it, or you've heard of it but don't fully understand how it works or how to actually do it, this video is going to change that. By the end of this, you'll understand exactly what index funds are, why they work, how to evaluate and choose them, which accounts to hold them in, and how to build a simple, effective portfolio that can grow your wealth over decades without requiring you to become a professional investor. Welcome to Global Finance Watch, where we break down the strategies, trends, and decisions that drive real financial outcomes. Subscribe if you haven't, new videos every week. Let's start with the basics. An index fund is a type of investment fund designed to track the performance of a market index. An index is simply a list of securities, stocks, bonds, or other assets, grouped together according to a specific set of rules. The S&P 500 is probably the most famous index. It tracks the 500 largest publicly traded companies in the United States: Apple, Microsoft, Amazon, Nvidia, JP Morgan, and 495 others. When people say the market went up today, they're usually referring to the S&P 500 or the Dow Jones Industrial Average, which is a similar but smaller index of 30 large American companies. An S&P 500 index fund owns a slice of all 500 companies in the index, in proportion to their size. When you buy shares of that fund, you're instantly buying a tiny piece of all 500 companies at once. When those companies grow in value, your investment grows. When they pay dividends, you receive a proportional share of that income. The alternative to index fund investing is active management, where a professional fund manager picks individual stocks, tries to time the market, and attempts to outperform the index. Active management sounds like it should be better. Smarter strategy, professional expertise, constant attention. The problem is that the evidence, accumulated over decades, tells a different story. According to the S&P Dow Jones Indices SPIVA report, which has been tracking this data for over 20 years, roughly 90% of actively managed large-cap funds underperform the S&P 500 over a 15-year period. Not 10%, not 40%, 90%. The professional managers, with their research teams and Bloomberg terminals and decades of experience, still can't consistently beat a fund that simply owns everything and does nothing. Why? A few reasons. Active funds charge significantly higher fees, which compound against you over time. They trade more frequently, generating tax costs. And markets are highly efficient, meaning publicly available information about companies is already reflected in stock prices, leaving little edge to exploit. The few managers who do beat the index in any given period are usually replaced by different managers who beat it the next period. There's almost no reliable persistence in active outperformance. Warren Buffett, arguably the greatest active investor of all time, has famously said that for most investors, a low-cost S&P 500 index fund is the best investment they can make. He's backed that up in writing, instructing the trustee of his estate to put 90% of his wife's inheritance into a Vanguard S&P 500 index fund when he dies. So what makes index funds work so well? Three things above all others: low cost, diversification, and time. Cost is the most underappreciated factor in long-term investing. Every investment fund charges an expense ratio, an annual fee expressed as a percentage of your assets. An actively managed fund might charge 1% per year. A typical index fund charges 0.03% to 0.20%. That difference sounds small, but compounded over decades, it's enormous. On a $100,000 investment growing at 8% annually over 30 years, the difference between a 1% fee and a 0.05% fee is roughly $180,000 in final portfolio value. You pay more in fees, you keep less in wealth. Index funds win on cost by a wide margin. Diversification is the second factor. Owning 500 companies means no single company's failure can destroy your portfolio. Enron collapsed. Lehman Brothers failed. Countless individual stocks have gone to zero. But the S&P 500 index simply removes them when they fall out of the top 500 and replaces them with the next largest company. The index is self-cleaning. You always own the dominant companies of the era without having to predict which companies those will be. And time is what turns all of this into wealth. The S&P 500 has returned an average of roughly 10% annually over the past century, including all the crashes, recessions, wars, pandemics, and political upheavals of that period. It has never permanently declined. Every bear market in history has been followed by a recovery. The investors who lost money in index funds are almost exclusively those who sold during downturns. Those who held through every crash and kept contributing came out the other side significantly wealthier. Now let's talk about how to actually choose an index fund. There are thousands of index funds available today, tracking everything from the entire U.S. stock market to specific sectors like technology or healthcare, to international markets, to bonds. For a beginner building a simple, long-term portfolio, you don't need most of them. Here's how to think about the landscape. The most important decision is which index to track. For U.S. stocks, your primary options are the S&P 500, the 500 largest U.S. companies, or a total market fund, which includes those 500 plus thousands of smaller U.S. companies. Both are excellent. The total market fund gives you broader diversification. The S&P 500 is more concentrated in the largest, most dominant companies. Over long periods, their performance has been very similar. For international exposure, a total international stock market fund gives you ownership across developed and emerging markets outside the U.S., Europe, Japan, China, India, and beyond. Many investors hold a combination of U.S. and international funds to avoid being entirely dependent on one country's economy. For bonds, a total bond market fund provides exposure to U.S. government and corporate bonds, which tend to be less volatile than stocks and serve as a stabilizer in your portfolio during stock market downturns. Once you've decided on the indexes you want to track, you evaluate funds using 3 criteria: expense ratio, lower is always better, and for major index funds, the difference between providers is now tiny. Vanguard, Fidelity, and Schwab all offer funds with expense ratios below 0.05%, meaning you pay less than 50 cents a year for every $1,000 invested. Some Fidelity funds have 0 expense ratios. Tracking error: how closely the fund actually follows its index. For major funds from reputable providers, this is rarely an issue, but it's worth checking. And fund size and liquidity: larger, more established funds are generally more reliable and efficient. Some of the most widely held index funds in the world are worth knowing by name. Vanguard's VOO tracks the S&P 500 with an expense ratio of 0.03%. Vanguard's VTI tracks the total U.S. stock market. Fidelity's FZROX is a total market fund with 0 expense ratio. iShares Core S&P 500 ETF, ticker IVV, is another major S&P 500 option. These are not endorsements. They're simply among the most used and most studied funds available to U.S. investors. Now let's talk about where to hold these funds, because the account matters almost as much as the investment. If your employer offers a 401k with index fund options, that's your first stop. Contributions reduce your taxable income today, your money grows tax deferred, and if your employer matches contributions, You get an immediate guaranteed return on that portion. Make sure you're contributing at least enough to capture the full match before putting money anywhere else. A Roth IRA is the next priority for most people. You contribute after-tax dollars, but your money grows completely tax-free, and qualified withdrawals in retirement are tax-free. The contribution limit in 2024 is $7,000 per year, or $8,000 if you're over 50. A Roth IRA is particularly powerful if you expect to be in a higher tax bracket in retirement than you are today, which describes most young adults building wealth. You can open a Roth IRA at Vanguard, Fidelity, Schwab, or any major brokerage and buy index funds directly inside it. A traditional IRA gives you an upfront tax deduction on contributions instead, with taxes paid on withdrawals in retirement. This tends to be more advantageous for people in higher tax brackets today who expect to be in lower brackets later. Once your tax-advantaged accounts are funded, a standard taxable brokerage account lets you invest unlimited additional amounts with no contribution caps, though you'll owe taxes on dividends and capital gains. The order of operations for most people is 401k up to the employer match, then Roth IRA to the annual limit, then additional 401k contributions, then taxable brokerage. Following this sequence ensures you're capturing the highest value opportunities first. The last thing to understand is how to actually build and maintain a portfolio once you've started. The simplest approach is a three-fund portfolio, a concept popularized by Vanguard founder John Bogle and the Bogleheads investing community. It consists of 3 index funds, a U.S. total market fund, an international total market fund, and a U.S. bond fund. The allocation between them depends on your time horizon and risk tolerance. A common starting point for a young investor with a long time horizon is 70% U.S. stocks, 20% international stocks, and 10% bonds. As you approach retirement, you gradually shift more toward bonds to reduce volatility. An even simpler option is a target date fund, a single fund that holds a mix of stock and bond index funds and automatically adjusts the allocation as you approach a target retirement year. A 2055 target date fund, for example, is currently weighted heavily toward stocks and will gradually become more conservative as 2055 approaches. For investors who want maximum simplicity, a target date fund inside a 401k or IRA is an entirely reasonable approach. Once you've chosen your funds and your allocation, the key behaviors are straightforward. Automate your contributions so money goes in consistently on payday, regardless of what the market is doing. Rebalance once or twice a year if your allocation drifts significantly from your targets. Most brokerages now do this automatically. And when the market falls, which it will, do not sell. The correct response to a market downturn as a long-term index fund investor is to keep contributing and let the shares you buy at lower prices add to your future returns. The investors who get hurt in index funds are the ones who treat them like trading vehicles. The investors who build significant wealth with them are the ones who treat them like a background process, set up, automated, and left to compound for decades. Let's bring it all together. Index funds work because they give you instant diversification across hundreds or thousands of companies at extremely low cost and with no requirement to pick winners. Over virtually every long time period studied, they have outperformed the majority of actively managed funds. The S&P 500 Index Fund is the most widely recommended starting point. You evaluate funds by expense ratio, tracking accuracy, and fund size. You hold them inside tax-advantaged accounts, 401k and Roth IRA first, before adding a taxable brokerage account. And you build your portfolio, automate your contributions, and let compound growth do the rest. Passive investing doesn't feel exciting. There's nothing to monitor, nothing to react to, nothing to brag about at a dinner party. But over 20 or 30 years, it produces results that most active strategies can't match. That's the playbook. Simple, proven, and available to anyone willing to start. If this was useful, subscribe and check out our Investing in Stocks for Beginners video and our guide on how investing works for more on building your financial foundation. Drop a comment below with the first index fund you're going to buy. We'll see you in the next one.